Hey guys, Tim Melvin here, coming to you on a Friday afternoon. I was going to try to get some filming done earlier this week while I was in Miami at the Benzinga Psychedelic and Cannabis conferences, but left the power cord to my laptop home, so I had to be very stingy about uh, about my computer usage over the 3 days that I was there. Naturally, I looked at the Miami Beach Best Buy, and they said that they had six of these cords in stock, so I went flying down there. Uh, Once I realized what had happened. And of course, they had zero cords in stock. Very frustrating because Miami Beach traffic is not a joke during the business day. But what are you going to do? Markets today are selling off, getting hammered down over 800 points as I am filming this at about a little after 2:30 in the afternoon. Primary culprit here is, of course, interest rates. We had been seeing some strength earlier in the week, thanks to some, I guess pretty decent earnings reports, except for Netflix, which was an absolute disaster. Lost subscribers for the first time. Probably going to lose subscribers again in the next quarter. I've said all along, streaming is going to be a tough business, and there's a lot of people I wouldn't mind competing against, but Amazon's not on that list. I don't want to have to go head to head with Amazon. I think Netflix will find it increasingly difficult to do so. Interest rates are moving higher. They're moving higher rapidly. And the timing model that I so kindly liberated from Dan Rasmussen and his guys at Verdad Advisors is showing that credit spreads, are not at a level where we're going to see capitulation or where it's time to really get scared and get out of the market. Now, when I look at it, we're in the inflation stage. We should be, according to this model, and it's a really good model that outperforms the market with a fraction of the drawdown over the last 20 years or so. We should right now have about 10% of our portfolio in small cap value, highly suggest small cap banks, and gold. Me being me, I've ignored the gold selection and bumped up the small cap value because we have predominantly holdings in small banks. But what it's screaming louder than anything else is you should not be in the indexes or in large cap stocks right now. Now, if we get some more widening in credit spreads and we see the yield curve start to steepen, it's going to have to steepen quite a bit to get over the 10-year median. If those two things happen, it's going to be time to playing a lot more defense than even I am playing now. We're not there yet. I'll let you know because, like I said, the model has been very accurate over the testing period. And it's worked pretty well since I've been kind of using it to track things over the last year or so. So anyway, not taking credit for it. Totally Dan Rasmussen and his team's work. But, all ideas are meant to be stolen. So I stole that one and we'll use it for our benefit going forward. Not even close to suggesting that we should be buying indexes or large cap stocks at this point in time. Small banks, special situations, I think that's where you really have to be focused right now to make some money in this market. Anyway, I was reading over a bunch of bank reports this morning, getting ready to write the Banking on Profits letter. We had a whole, few companies that have reported. And guys, look, small banks are really bucking the trend. I know big banks, even the larger regionals, struggling a little bit this quarter. The smaller banks, 2/3 of our smaller banks have increased the dividend already. Now it's early in the reporting season. The next 2 weeks are really the fast and furious weeks. And 1/3 of them have announced new stock buybacks. So I expect that to continue. We're seeing, strong outperformance on profits and margins. Everything is going well. They're benefiting from higher interest rates. Most of them have been hoarding a little bit of cash to reinvest as rates go higher. So I remain very bullish on the short-term outlook and the long-term outlook for small banks. I mean, why not? It's been working for 25 years now. I expect it's going to continue to work just fine. And we are seeing some signs of accelerated merger and acquisition activity in the marketplace. And I think that it's eventually going to find its way. We've had 3 takeovers this year so far. We are on pace for another double-digit year in takeover activities. And so I think we'll see that happen, and quite excited about it. Yields on the 10-year right now, guys, we hit today 2.90. On January 1st, we were at 1.62. So we've gone up 79% in the 10-year interest rates. That is really not good news for the stock market. Most of the high flying tech stocks that we've seen dominate the market in 2020 and 2021 are very much valued using a model that's highly dependent on interest rates. Right? There's no profits coming in. We're deferring profits back out for many years, many years, and bringing them forward, trying to figure out what the discounted value of that is. To do that, you have to plug in an interest rate. The higher the rate, the less the company is worth. So you're plugging, if you're using the 10-year rate or the risk-free rate, they're going up really quick, and it's going to very quickly change the valuation on a lot of these stocks. And that's exactly what we're seeing. We talked about it this morning on Money Morning Live, which, by the way, I'm on there most Fridays at 12:30 with my son-in-law, Garrett Baldwin, talking about the economy, about the markets, about what we see, what's going on in the world, about momentum and special situations. So you might want to make a note and check that out. It's a pretty interesting conversation. Garrett is a very, very strong economist and kind of global trend identifier, highly trained, very accurate. They're great conversations. You might want to drop by some Fridays at 12:30 just to check it out and see what we're talking about. So we're probably going to see, guys, another 50% hike. Not 50%, 50 basis points hike in interest rates at the May Fed meeting. And then it's highly likely that we see 50 basis points in June as well. And, looking at what some of the economists are saying, 75 basis points may not be off the table for May. I think that would be hyper aggressive. Chairman Powell indicated again this morning in a talk that he's thinking 50 basis points. More importantly, in May, probably going to see them start to shrink that balance sheet. That means that the biggest buyer of mortgage bonds and treasury bonds in the market is going to slowly turn in to the biggest seller of treasury bonds and mortgage bonds in the market. That could accelerate the move in interest rates higher, bringing further damage to the general broader stock market, and particularly those high flying, high multiple, no profit tech stocks that have led the way up over the last 2 years. If you're going to try to bottom fish those, and I see that Kathy Woods of ARK Funds was out doing exactly that this week. If you're going to try to bottom fish those, my friends, you better use a tight stop, or it's going to cost you a lot of money. That's an instance where you're going to want to take a lot of small losses before you eventually see the large gain, is exactly how I think that will play out. Now, I did see today something pretty interesting here. RV manufacturer Lazy Day Holdings, the symbol's LAZY. It's a former SPAC, been around a while. Anyway, they weren't growing fast enough at all. Their competitors were growing at 5 to 10 times the rate, all by acquisition. It's an industry dominated by smaller dealers, so there's a very attractive roll-up potential there. And companies like Camping World Holdings have taken advantage of it. They've really grown a fantastic business. Lazy Days had the runway, and they haven't used it. They've only made about a dozen acquisitions over the last 4 or 5 years. Very slow, measured pace that's not allowing them to keep up. It's attracted the attention of some activist investors. Most notably David Kamen of Kamen Capital and Coliseum Capital. Eventually, B. Riley came in and got involved in this deal. And B. Riley, through their merchant bank, made a $25 a share offer for the company, with the stock trading at around $17. Pretty fair premium. The board, without giving much of a reason, turned it down. Kamen has gone ballistic. He's sent two letters to the company so far, outlining what he thinks is a collective arrogance. And the second letter actually called out board members by name, pointed out how much stock they did not own, and that most of their equity holdings was a result of stock options that were given to them by the board of directors. So in other words, they had no equity interest in the company that they had paid cash money for. And he accused them flatly of failing to protect shareholder interests. This company is very much in play, guys. Kamen owns 10%. Coliseum owns another 8.5%, and B. Riley also owns almost 8%. They've almost got enough, guys, to just force this out. Heavy institutional presence in here, a lot of firms in there that I can look at and say they're going to go with B. Riley and Kamen if this comes to a proxy fight. David Kamen's angry enough at how badly the company's been misrun and just the flat arrogance of turning down without comment a very attractive offer. This company is in play. I think we're going to see an offer. I think we're going to see a deal get done. You can buy the stock outright here at around $20.28. I think a deal's 25 or higher. Or if you want to be more aggressive about it, you can sell the May 20 puts. And if you can get $1.27 or better for those, that's the fair value that I calculated with the Black-Scholes calculator this morning. That's 6.3% for about a month, or almost a 75% annualized rate of return. And you end up owning the stock at about $18.73. If the options expire worthless on May 20th, then you can just resell the puts again going out to June, depending on what the pricing is. So that's kind of back into the stock using options, collect some premium to take advantage of this special situation. I don't think it's a very aggressive trade because it's trading at very low multiples. I don't see massive downside from these levels in the stock. It's trading at like 7 to 8 times free cash flow and earnings before interest and taxes. So, and the RV business has been doing well post-COVID. They're better than one would have thought with the rising gas prices, but people have decided to just kind of hit the road. And different way of vacationing. And I have to admit that I have considered purchasing one of these giant things myself, but I always talk myself out of it because just don't really have the time to hit the road at this point in time. Anyway, I was at the Benzinga first on Tuesday, the psychedelic conference. Then I hung around on Wednesday for a good portion of the cannabis conference. And I'll tackle the psychedelic conference first. Now, I'm fascinated by psychedelics. I'm very familiar with the studies going all the way from the 1950s and 1960s and even into the 1970s. They were doing a lot of studies on using psychedelics to solve mental issues and to deal with addiction problems. And the results were very promising. And boom, they got shut down. They got shut down hard by the federal government, who decided that psychedelics were actually just really terrible things that only the hippies took, and we needed to end the practice of doing research. The research was shut down hard, was not opened back up again until recently. Now we've got Johns Hopkins University, one of the most respected research hospitals in the country, and some other schools starting to take a deep look at the use of psychedelics for things like anxiety, PTSD, particularly in members of the military coming home from combat areas, addiction, again, depression. So there's a lot of areas where there's some promising research, very strong clinical results. And as one of the speakers at the conference put it, the drug industry, the pharmaceutical industry, has totally failed in treating most mental health. They can keep it at bay a little bit, but it doesn't really overcome the anxiety, the depression, the PTSD, the addiction, where there is growing evidence that psychedelics can do exactly that. We're a long way from the finish line. This is not an aggressively investable industry right now. I love the idea of this industry. I think there's going to be massive winners. Right now, this is tiny, guys. There's maybe 1,500 ketamine clinics around the United States, and most of them are in strip malls on the wrong side of the railroad tracks. This business has a long way to go to get into the mainstream. I think we're going to get there. It's just going to take a very long time. There's 3 companies in the industry, okay, that are not in desperate danger of going bankrupt due to lack of funds that attract my eye. So a lot going on in the venture capital space. In the public markets, you have Atai Holdings, which is the giant, okay, run by out of Germany. Peter Thiel has backed them. They're doing some cutting edge research. They got a lot of drugs in trial. Compass Pathways, same thing, several drugs and molecules in trial. And then you've got MindMed, who is doing some also cutting edge advanced research. And they have, a couple of years of cash in the bank. They've got some backers that will probably be willing to come back. Very well received by venture capital. They've been willing to put money into the thing. So I think that if you want to get into this at this stage, then this is hard for me as a value guy, but I tell you, probably going to end up doing this, especially with the prices just getting waxed in the market sell-off here. You only have to buy 2 stocks here. Atai owns over 20% of Compass Pathways. and they will be buying more. They'll be up to 30% here pretty quick. Peter Thiel, of course, still has a very large investment in it. MindMed, which is MNMD, also, so if you just buy those two stocks, put them away, forget about them. They're going to trade all over the place on rumors, news, trials, all that. These are the three companies that I think have the best shot of actually getting all the way to market with psilocybin, LSD, ketamine, and other psychedelic drugs to treat various mental health conditions. But don't plan on trading them. Don't get into the more speculative stuff. Buy very small amounts, because the winners here are going to win really big if you choose to play in the psychedelics market. Now, cannabis was a little more informative. I went to this conference back in 2018. It was held at the Eden Rock there instead of the Fontainebleau. Drove down. Enjoyed, very nice time. The guys from Benzinga are great. I've been friends with them forever. We do some business together. They host my Banking on Profits newsletter, as you guys all know. Just great guys. So that conference was heavily retail. Lots of husbands and wives. Several of them subscribers of my old service. So had conversations, but it was heavily retail dominated. This time, not so much. This was a very institutional conference. There was about 2,000 people, as I recall, registered. This was all funds looking to raise money, institutional investors looking to invest money in funds and directly into cannabis companies, younger cannabis companies looking for sponsorship and kind of venture capital. Very institutional feel to this conference compared to several years ago. Retail is out of cannabis stocks. The speculative fervor is gone. Like Elvis, they have left the building. There's zero interest. What that means is it's time for us to get really active in starting to accumulate long-term positions of certain cannabis stocks. Now, the most impressive one that I talked with and about this week was MariMed. This is a stock that I have talked about in the past. It's MRMD. They're a multiple state operator. They're in Nevada, Illinois, Massachusetts, and Maryland. In Maryland, they just doubled the amount of space that they have for cultivation. They've opened a new dispensary, and they've converted a managed dispensary to an owned dispensary. And that's really their business plan here. They've been managing a lot of dispensaries around the country for a fee and royalties and commissions. They've had options to buy. They're exercising them. They're not going to have a percentage of the business anymore or a percentage of the profits and revenues. They're going to have all of the profits and revenues. These guys are producing cash flow. They're trading at about 7 times cash flow right now, 5 times that we think they'll have this year based on the number of new conversions that they expect to do. The big knock here, this is a 70-cent stock, guys, and this is not something I usually recommend. The big problem here is they only had a U.S. ticker, which meant most of the ETFs in the United States, based in the United States, cannot invest in the stock because they're usually limited to just those with Canadian tickers. So that's ETFs, and no institutional investors could get, no U.S. institutional investors could get into it for similar legal restriction reasons. They are getting a Canadian ticker. Institutions and ETFs will be able to buy the stock. That's going to bring buying pressure into this stock and help drive the shares dramatically higher. Because this, look, it's a 10-bagger. It's a layup. As Schedule 1 is, marijuana is coming off Schedule 1. Not as quick as we hope. No way, and you know what, before that it happens, before the midterms. But 2023, I think is going to be very much on the table and a very high probability. I don't think the Fed's going to say, oh, it's now legal federally. I think they're going to take it off Schedule 1 and let the states decide for themselves. That's the smartest course. Safer banking should also pass after the midterm elections. And owning a cannabis dispensary can be, a little more like owning a liquor store and a lot, less like owning an illegal drug business where you have cash laying around all over the place. So those two developments are going to be fantastic. Companies are going to start to explode in price. MariMed, I think, long-term, patient, aggressive investor, you're looking at least a 10-bagger. They've got cash in the bank. They're generating more cash. They're growing. Management's very smart at this. They thought out what they're doing. So I think the stock's got a lot higher to go. Now, the other thing that I'm going to mention is, once again, Morningstar. If you go in there and you look, very conservative research service. They've only got 28 5-star stocks, the ones that they think really have outstanding, superior appreciation potential over the next 3 to 5 years. And they have a fantastic track record of identifying deeply undervalued activities. Well, right now, guys, Tilray, TLRY, the Canadian operator. And remember, all Canadian operators have a plan, and most of them have options and convertible investments in U.S. operators. They all have a plan to jump into the U.S. market as soon as cannabis comes off of Schedule One. Tilray, they've done a fantastic job here of diversifying away from the Canadian markets where, hey, cannabis has become a commodity in Canada, very much so. There's restrictions on branding, so it's kind of tough to really carve out a moat. They have gone from just about 300,000 last year in international sales to 16.5 million in 2021. So they've really aggressively expanded into international markets. They're an early player in international markets, which is important because there are very high regulatory barriers to entry. So there's a wide moat around that portion of their business. That's a 5-star. Green Thumb, the symbol here is GTBIF, also a 5-star, as is Canopy Growth, that's CGC. And of course, Curaleaf, one of the biggest cannabis companies in the world today, CURLF. I also continue to like Cronos, the company that is about 50% owned by Altria. I think it's going to be their primary vehicle for expanding in the U.S. cannabis market. So that's what we have today. We've got psychedelics, we've got bank stocks, we've got some angry activists that I think we're going to push Lazy Day Holdings into selling the company sooner rather than later. Hopefully B. Riley ends up with it because their merchant banking division is fantastic at getting companies turning around, growing the business, and then someday spinning them back out as an IPO. So, and I'm a B. Riley shareholder, so that would be good for me. So anyway, guys, I'm Tim Melvin. That's all I've got for you. I'm going to try to be much tighter on my schedule and get back to you with another video on either Monday or Tuesday. Thanks for watching, and I will talk to you guys real soon.